Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from equities to FX to bonds. For our latest views, visit macrohive.com. Before I start my conversation, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up for our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com/free. All of these make a big difference to me and make the effort of putting these podcasts together well worth the time. Finally, and my third request is that if you're a professional or institutional investor, do get in touch with me. We have a very high-octane research and analytics offering that includes access to our world-class research team, our model portfolio and trade ideas, machine learning models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details. Now, onto this episode's guest, Alex Campbell. Alex has 20 years of experience at the intersection of finance and data. He has been a global macro investor at firms like Bridgewater Associates and a prop volatility trader at Lehman Brothers. Prior to his career as a data-driven speculator, Alex received an MBA from Stanford Business School, an MPhil in economics, game theory from the University of Oxford, and a BA in economics from McGill University. Now, onto our conversation. Greetings and welcome, Alex. It's fantastic to have you on the podcast show.
Thank you for having me. It's great to be here.
Great. Now, before we go into the meat of our conversations, I do like to ask my guests something about their origin story. So it'd be great to hear in your own words what you studied at university. Was it inevitable you'd enter finance, and some of your key career milestones?
Oh, yeah. So I actually got into markets kind of as an extension of fantasy baseball. I was in grad school over in the UK at Oxford to do game theory. I was trying to do experimental economics and a bunch of stuff that was kind of pre-machine learning. And I'm like a pretty good mathematician, but I'm not like an amazing mathematician. I'm not like, beautiful mind level or whatever. And so I spent a lot of my time playing fantasy baseball against my friends from back east on the East Coast. I read Michael Lewis's book, Moneyball, and my then girlfriend said, "You should do this for a living. You don't seem very happy as an economist." And so I got to the end of my MPhil and applied to banks, applied to trading jobs, basically. I managed to talk my way into the prop desk at Lehman. This is in 2007, back when you could be 23, 25, and they'd let you run money for the bank, right? Started by getting coffee and, booking trades and that kind of thing. And then slowly, moved into actually a portfolio management role when people started getting fired and I started picking up their book. So I traded at Lehman for about a year or two through the financial crisis, actually through Nomura, went to Stanford Business School, kind of caught a little bit of an entrepreneurial bug, and then ended up at Bridgewater Associates, where I did a little bit of work on the European banking system. Again, that kind of credit background was always there. Worked on a project called Dots, which was kind of like fantasy baseball for humans, which was an interesting experience, kind of as a startup within a bigger organization. And then that gave me enough kind of credibility with the big guys to go and do oil and copper and commodities. And so, I ended up in markets because I liked reading the news. I liked, looking at what's going on in the world. Obviously, if you follow me on the internet, I kind of have a big mouth, so that was kind of part of it. And it was the place where you were paid for being right about the world and kind of figuring out what was going to happen before other folks, more so than making other people happy. And that's always just been resonant with my personality.
That's a great story. And that's great to hear. And you mentioned Bridgewater there. And of course, Bridgewater has quite a reputation and it has a very specific culture that and Ray Dalio has written of, there's numerous books he's written around that all. What was your experience like? I mean, I know people at Bridgewater as well. It has a very specific culture, kind of this kind of radical honesty, direct feedback. How did you find that culture, number one?
Yeah, that was my favorite part of Bridgewater, actually. So I went in having played a lot of sports, contact sports in high school and college, been a competitive debater for a long time, both in undergrad and grad school. and a Lehman trading floor. And these are high conflict areas where that direct exposure to someone else's ideas are kind of what drove me forward. And actually, what I didn't like about Lehman was all the stuff behind the scenes. So when you go through 8 rounds of firing at a place like Lehman, because the bank is dying and they're just laying people out left and right. I just remember seeing people in the corner talking, or someone who was good getting fired because they didn't have the right political relationships, or even just like how people got jobs felt very back room to me. And I never liked that. Maybe I'm a little bit on the spectrum, I think. And so I always like that direct interaction. And so for me, it was like catnip. I kind of found it as this place where, at least in the ideal, the best ideas won. It didn't matter who you were, it mattered the quality of your ideas. And that resonated a lot with me. And so I think a lot of people go there and they kind of expect it to be a very political financial institution, like a lot of other places. And they try to do politics, and they kind of, it doesn't go well for them. And so, especially when I was there, this is now 12, like a long time ago, almost a decade ago. A lot of the stuff you'd see online was the people who left unhappy, who kind of came in and either were told that they weren't the top of the right of the bell curve, or they tried to play politics and they kind of got roughed up and they left kind of confused and scared and like angry. And so that was my experience. Now, obviously, every place has bureaucracy and it's a big institution. And so most of the reason I left was not because I didn't like the culture, but just because I felt the institution had gotten institutional, and I wanted something more entrepreneurial. And I wanted to kind of see what it would be like if I drove that energy. And so I you know, I think the culture's actually had a huge impact on the world, and I think raised a little bit. I don't agree with about everything, obviously, especially not China, um, but I think he's right about culture, and you see that in other places, the way they talk about transparency, the way they talk about feedback, even the whole dots thing, which was essentially having a domain language or schema about humans, and then trying to be very diligent about aggregating feedback. That was the notion of it. The goal is to understand what you are like and what I'm like, and empower people so that if you're not good at a certain thing, people don't keep asking you to do that thing. They let you do the stuff that you're good at. Some people are creative, some people are reliable. Those don't always go together. And so you take the most creative person in the world, and you make them push a button every day at 9:02 a.m. You might be disappointed. Whereas if you take that person who's amazing at the 9:02 a.m. button and you ask them to, imagine some new way of explaining something to a client or an investment philosophy or whatever, you might be disappointed. And that's okay. Sometimes you need both of those people. In fact, you need a lot of different kinds of people to do anything, really. And so that part I always felt was very empowering to people, and I was a big fan of.
No, that sounds great. I mean, when I listen to it, it sounds almost like a scientific approach to culture. How do you establish corporate culture? How should you get feedback done? Whereas I've worked at lots of big institutions, and the feedback and the NDP reviews, I mean, by its name, it kind of implies there's some honesty there, but in reality, it's just a game, and there's all sorts of things going on, and it's not really true feedback, or the follow-ups aren't really sort of followed through. So there's this kind of layer of performative sort of nature of all of it, and there's no metrics to track. There's no, it's this kind of just a nice corporate veneer rather than a reality.
Yeah, and people still would try to game. I mean, they wouldn't last very long if they did it inartly. Like, you can imagine, the tell a real story. You have a bunch of interns or whatever, and you're constantly evaluating these interns. Who's good at math? Who's good at bonds? Who's good at stocks? Who's good at all these different features? And then you ask them to rate each other, and everyone has very correlated ratings of who gets it and who doesn't. Let's say on this particular topic, or even in a particular moment, particular day. And then you see someone else, and I remember this kid, just had total inverse ratings, and of course put himself on the top, right? And in a world where that just goes in a machine and you never see it again, maybe he that's what he actually believes. He didn't, but like maybe that's what he actually believes. In which case, okay, he thinks differently, and some people think differently. But you go into follow-up conversations like, why did you rate Sally at the bottom? Like everyone thinks Sally is the best person in class, and blah blah blah. If you actually go all the way through on that thing of trying to get to truth, you can pretty you can work it. It's just really expensive in terms of time. It's really expensive in terms of energy. It's really expensive in terms of being on that topic versus on the topic of making money. Um, so something to think about, and I think that investment in culture is really important. And every institution has its own culture, but I'm a big believer in transparency, a big believer in feedback, a big believer in a lot of the things that are kind of legacy from that shop. Yeah.
Yeah, that's great to hear. And speaking of making money, I mean, were there some? I mean, how's it affected your approach to investing in markets?
I think I've always been a systems thinker, but Ray's genius, he's a very good trader, but he's a genius when it comes to humans and people and systems and then explaining them. That's I think his 10 Sigma kind of approach and why the firm's so big and has such a great legacy. It was to just test your ideas always and all the time and think about how you could be wrong. Because in markets, you're never going to get exactly what you think. The market's always going to throw you a punch here or there. And if you haven't looked, I mean, back testing is just an example, but like a lot of people will back test stuff that's only like a couple of years old. And this actually happened to us at Lehman, where I remember my boss betting on Citigroup versus Deutsche Bank implied volatility. And it's, oh, mean reversion is the big thing in, vol spaces. People talk about mean reversion. And Citigroup had gapped up in terms of its realized volatility and its implied volatility versus Deutsche Bank. And we're like, well, look, usually Deutsche Bank's more volatile than Citigroup, so we have to short Citigroup volatility and buy, and buy Deutsche Bank volatility. And the irony was, this is 2007. We had like 3 or 4 years of back history, okay, in these option surfaces. If you had just looked at realized volatility, which I did eventually, not implied, you don't need implied volatility back history to look at this. You can look at it since 1990. There were tons of times where Citigroup realized way more volatility than Deutsche Bank, way more. And we were just being myopic and naive and overly narrow in our aperture. And of course, the reason that Citigroup was trading volatile was because it was a US financial crisis and US real estate was volatile, and Citigroup had a lot of, MBS and CDOs and all that stuff. And he got carried out. Okay. So, Bridgewater takes that to the extreme and says, don't just test it in an individual country, which I think most people do. Go try to test it in other countries. Oh, you think that X trades Y? Well, go look at the 1980s. Go look at the 1930s. Go look at across countries. Go look at emerging markets. And that is really hard to do data-wise. Like it's just, it adds an incredible burden from idea generation to execution. But it also means that you kind of know what you don't know, or a lot more of what you don't know, because maybe you couldn't test it in emerging markets, or maybe you couldn't test it in a rising interest rate environment, or maybe you didn't have the back history, or you go, whoa, stocks. Let's talk about stock volatility just generally. In the Great Depression, you had 100 vol moves. Stocks are moving at 100% a year, basically, in terms of daily volatility. Well, that happened in 2020, right? And so when COVID happens and you see the markets going womp, womp, womp at the beginning of it, just knowing that stocks can do that. I mean, the depression is different than COVID, obviously, but maybe you don't sell as much volatility in that moment. Or similarly, like oil, having looked at the history of commodities, maybe you don't think that oil can't go negative in April 2020 and it goes to negative 37 or whatever. And so I think about it a lot as like opening the tails of the distribution, kind of like Taleb talks about this, but trying to actually get your arms around it as opposed to just being like very existential about it. And then forcing yourself to really try to put those ideas in data, have the data say to you what it's doing. Now, they do a thing that I think not everybody can do because it's just so expensive in terms of humans. Now, this is where, again, I started to work on AI to solve this problem, but which is make the robot trade it. Like teach the robot how the market works and then make the robot trade it. And then you like watch the robot and make sure the robot doesn't make any mistakes. But that last step in 2005, you can imagine, oh my God, like so expensive in terms of humans and data and smart humans to make that machine run and to turn that machine. And so that affected my life because I kind of thought I saw the future. I was like, oh my God, these guys understand how the world works. The world's gonna be run by this data. I got to go work on this data problem because the AI is coming. The AI is coming. A little too early, honestly. But that had a huge impact on me. I mean, simple question, long answer, but yeah.
Yeah, no, and that's a great answer. And actually, we'll come back to what you're doing now towards the end, so we can kind of learn more about that. But in terms of commodities, when it comes to investing, commodities is always kind of the side assets. There's obviously the big guys, bonds, equities, and then in recent years, there's been private markets as well. But they're kind of the core of the portfolio, and then you kind of add maybe currencies as an overlay, or within macro, then commodities get thrown in as an alternative asset class. So, I mean, how do you think commodities should be used within a diversified portfolio?
I mean, that last part is the most important, which is diversification. Most commodities people are a little bit weird. Like we're not your normal investors. It kind of starts with the gold bugs who've been talking about the end of the dollar for.
You said that. I didn't say that, but
no, yeah, I said it.
I agree.
We're all weird. We're all weird. Okay. But that's kind of our diversification kick. I mean, Ray was a commodities guy when he got started. He used to trade like hogs and cattle feeders and stuff. But I think most investors radically under-diversify. Let's just start there. They radically under-diversify. Okay, they do not have enough diversification in their portfolios. They own way too much stocks, most of them. They own way too much U.S. stocks, most of them, and they get bailed out by the fact that the U.S. has had this ridiculous run in its stock market for like 200 years, whereas there are plenty of times in other Western nations, let alone emerging markets, where investing in paper assets or investing in stocks, you lost your shirt. And so, again, this notion of increasing the diameter of your evaluation. Once you start realizing that, and this is not my line, I think it's Ray's line, that there's the only free lunch in investing is diversification, you realize that actually finding uncorrelated or lowly correlated assets should be probably the single most important pursuit of an investor. I think a lot of people really focus on their like one or two really high confidence bets. But even your most high confidence bets, usually you're only like 55, 60% accurate. You're going to lose money. And so you really want to have multiple positive return streams. I added a little bit of a twist to that, which made it hard for me to raise money back 10 years ago, which was not only should you look for positive return, lowly correlated assets, you should look for negative correlation and you should look for convexity. Meaning you should really take that to an extreme and try to find things that go up a bunch when everything else goes down. And that came from my Lehman experience and just like also coming from I had like chaotic childhood and stuff like that. But like this notion of, I remember being on the trading floor at Lehman and, we were the prop guys and we were a little cynical. And so we were making money when everyone else was losing money. We actually made money through the financial crisis. And we felt all smart and we were dumb because of course the institution blew up, so it didn't matter. But I just remember the incentive structures that when everyone else made money, you lost money, they'd be really mad at you. And they'd be like, oh, everyone's making, $10 million and you guys are down. What the hell, blah, blah, blah. And so this like weird incentive alignment thing, you see it in investor markets too, which is like everyone compares themselves to U.S. stock market. A lot of asset classes, which are not U.S. stocks, get benchmarked to the S&P, which is a bunch of tech stocks. It's just like nonsensical. Like you can avail yourselves of that asset class. You can avail yourselves of that return stream if you would like to. It's available. It's easy. It's SPY. Hit the button on the market. You go get it. You can even lever it up. It's pretty easy. Getting diversification to that is the hard part, and getting the portfolio balance right is the hard part. So commodities, guys, long story short again, start in that world. 1, 2, commodities are probably one of the only asset classes where you can actually do real demand supply work, like physical demand supply work. You can go look at the thing moving to the port, and the port goes to the warehouse, and the warehouse goes to the thing. And, ironically, in the last 2 years with the rare earth kind of explosion, people now realize that this is pretty important. It also means it's an interesting place to invest because it's a little bit less of a beauty contest than stocks, right? Stocks have this terminal value. So SaaS stocks get obliterated when everyone goes, oh my God, the terminal value. And then everyone goes and sells stocks and you're just trying to bet on what other people are betting. And like a lot of investors are really good at like managing that collective consciousness. You know, again, like the reason that oil goes negative in April 2020 is there's a bunch of barrels of oil coming out of the pipe. There's nowhere for them to go. Like they have to go somewhere. The tanks are full. So now we have to bribe people to like take boats out of service and like sit there, you know, in Texas and like take the oil. And I always liked that. It felt more like a machine to me than other things. And so it's that kind of combination. I think that kind of attracted me to commodities and makes me think that they're a nice complement to a portfolio.
And then how should one think about commodities? Because, you know, there are indices, you know, the Goldman's GSCI and there's a Bloomberg index, there's a number of indices. But then sometimes I wonder with those, do they just obscure, you know, as much as reveal? So, you know, but instead of that, I mean, do you view commodities in terms of the subcategories? So, for example, precious would be one, there could be softs or energy or like, I mean, how do you kind of think about commodities?
Yeah, it's funny because these assets or these commodities get grouped and then the group becomes a theme and then people like, you know, bet on softs versus industrial base or whatever. I got my start with gold. So I don't know if I'm a bug, but I'm definitely on the bug spectrum. Like I was trading gold back at Lehman. I think of it like a currency. Gold to me is very much a currency. I mean, I know some of it gets consumed, but most of it is being held for, you know, monetary purposes. It's fun that it has this industrial purpose. Silver is super interesting because it's both, and that's why it is such a crazy asset class. I think most people shouldn't really be playing too much with the futures. And what I mean by that is that there's a lot of return that's derived from the shape of that commodities futures curve. Backwardation, contango, these words that like sound like they're meant to be forgotten. And like it took me years. I still sometimes mess them up, okay, in like the right context or whatever. You know, it's like skew, term structure. You have all these like ways to describe these like shapes. It's just such a weird thing. Okay, backwardation. Okay, the front price is higher than the back. It's like, I don't know how that came about. Where, you know, sometimes I'm up to half of the return or more, especially if it's been a choppy market. Like agriculture's like this a lot because the prices are actually not that trending over long periods of time. Especially like recently beef has been, but you know, if you look at like 200-year price charts or 100-year price charts, like you get these like moves and then it'll stay in the same place for a long time. You're really making a curve bet, which is not what everybody really wants to do. So one, that's why you shouldn't have your whole portfolio should probably not be commodities because of that reason. Two, you know, generally there's this notion of risk premiums. And as an investor, you want to capture risk premiums. And commodity futures, especially when they're not in backwardation, don't have a provable risk premium. A lot of times they have like a negative risk premium. There's an argument that gold has a negative risk premium. So I don't like telling people to go invest in miners either, because a lot of times it's like you're just buying the thing itself with a bunch of leverage, and why don't you just buy a call option on it? But I think that these days I'm shifting a little bit on that, where just in terms of diversification, like if you had a big blob of commodity equities, it's probably you get a little bit of that equity beta or that equity risk premium, and you get a little of that commodity exposure. And we kind of know that we need to go make a bunch more stuff, which is not the case in 2012 or whatever. It feels like they're a good source for diversification now. So again, I'm giving you kind of like a generic answer, but
yeah, it was kind of a generic question as well. So, but in terms of, you mentioned gold, and there's been a lot of interest around gold over the past year or two, mainly because the price has gone up a lot. So you get all these tourists coming in. And kind of with Thesis is some kind of question around the role of the dollar. You know, there's central bank buying of gold. But then at the same time, you know, correct me if I'm wrong, but Bridgewater historically has tended to argue that you should have a structural allocation to gold as well. So speaking of gold, then, how do you think that fits into the portfolio, sort of structurally, and then cyclically recently? What do you think the story is there?
Yeah. I mean, after I left Bridgewater, I tried to start a gold fund, basically. So that tells you a little bit of my background. I used to say you should be denominated in gold. And this is before the big run up, which, when you have these huge run ups, you don't want to be so long something. Obviously, for the last like month, you see what happens. But I went around to a bunch of pension funds, endowments, and big investors, and I was kind of pitching this trade that said there's economic there's evidence of a bubble in the credit markets in China. The property markets looks extended. The banks look totally over their skis. The way to diversify yourself against this trend is to buy gold and denominate it in Chinese yuan as opposed to dollars. Now, this is a weird trade, but I can explain it in a sec. So the notion of, first of all, like there's twice as much money in China as in the US right now. If you look at M2, which to me just seems crazy. It sounds like 2.5. Right. So this is money in the bank account. There's more ways of counting money, obviously. But, do you really believe that if China opened its capital account tomorrow, that the money in China would be able to buy twice the money in the US? Like they buy us twice. No, that's ridiculous, right? That doesn't make any sense. Doesn't mean that they're not making a bunch of stuff, but it doesn't mean there's too much credit and money that's been created. Two, the households in China had this choice and still have this choice, which is like they don't have that many good savings vehicles. This is back when WMPs were running around and they still have these LGFVs and these kind of alphabet soup.
WMP, just for the benefit of the audience, wealth management products. These are
which was, if you've heard of Evergrande, which was the big property company that went under that we were short, they would wrap unsecured credit in a quasi deposit asset called a wealth management product, and then sell it to like mom and pop investors, which to me felt like criminal. Like, again, a Lehman guy here being like, this is going to end in tears. And it did end in tears, and none of these people got paid back. And so my argument was, they have a choice, which is either the government bails out the banks, in which case the currency probably falls, or the people get sick of putting their money in these crazy banks and they buy gold. And, it's kind of a heads I win, tails you lose situation. And so what the notion was, you buy a bunch of gold, you don't buy it in dollars, which is what most people were doing then, right? They buy GLD or they buy a gold future that's denominated in dollars. So then you're borrowing in dollars or selling dollars to buy gold. It doesn't make any sense. You should borrow in RMB and buy gold and maybe buy some dollars along with it. And this was back when gold would trade with what's called real yields, US real yields, where they were super tightly linked to US 2-year real yields and gold.
That sounds so quaint.
Yeah. And it was because you had this is a classic example of market trading, consensus trading consensus, where you had a bunch of people who were like, oh, look at this amazing relationship between gold and real yields. And then they would trade them so that they would trade together, right? And then Ukraine happens, right? And the US says, basically, we're not going to pay you your treasuries, Russia, and we're going to freeze all your dollars. And everyone wakes up and goes, whoa, it's less about the dollar and more about treasuries as a safe hold of asset and a reserve currency and gobbling up gold, excuse me. And then that also kicked off a little bit of this speculative frenzy. And now you have Chinese households as well, and Indian households kind of running out and buying gold. And so that's kind of where we are in that cycle. I think you do want to be a little bit cautious of when you see these kind of hyperbolic price curves to not be super aggressive into the thing. And so, yeah, I used to say 30%. I think Bridgewater used to say 15. So, I was more bullish. No kidding. Right now, I think you want to be back in the 15 to 30 range. Even 30 is a little bit chunky, just because of the volatility in the market and the correlation to stocks. And, we'll talk about
even 15. I mean, compared to what pension funds have, that's way bigger than what any of those guys would have. I mean, I remember what they have. They're like 0.0 something percent, I imagine. Yeah.
It depends on how much, if you can take leverage or not. So that's a big, because, you're kind of taking portfolio space there. But yeah, I mean, you got to remember, I was pitching this to people who were saying, we're not trading, this is the Yale model, like Swenson, bless his soul or whatever, Rip, one of the best endowment investors ever, basically, kicked the other Ivy League's butts by putting all their money in private equity and venture capital, like basically like 80% of their portfolio in this like crazy long duration, illiquid, super growth exposed asset class. And interest rates were zero. Okay. Short-term interest rates were zero. This is 15, 18, that kind of range. And I was like, guys, like you're buying a bunch of bonds basically. Interest rates are zero. Like, what do you think is going to happen when the interest rates go up? Get out of here. That was basically the result that I got. And now we've seen what happened, which is a lot of those books are overmarked. They're kind of, I don't want to say, lying, but they're not being totally transparent, let's say, about what those assets are really worth. And, the precious metal rally has been vicious. So um, I think that's kind of played out. And I think, yeah, I think especially if we see more chaos going forward, uh, you should expect gold to continue to do well. You should expect once silver gets through whatever the heck is going on there, you should expect precious to do
And do
well.
you have a long-term target for gold? I mean, do you
I'm
think
not
we
a
could get to
target guy.
10,000, say? I mean, what's is it, I mean, it could go to anything, are we
I'm not
saying?
a target guy. Because I got that kind of Bridgewater training. I'm a like wake up every day or every month or whatever
Yeah,
you do your like
understood. Yeah.
calculation and kind of just
Yeah.
like don't want to be long. And so the things that would make me out of the market are one, like peace in Ukraine would
Yep.
make me, that's a big signal. So you saw, I think it was last week or the week before, like one of these like silver cracks happened. The stock market was down, but also like someone spoofed a Bloomberg article saying like Russia wanted to go back on the dollar. And like that, all of a sudden everyone sold a bunch of precious metals. That is crazy because they're not in the dollars because they're in Ukraine. So it's like, yeah, I'm sure if they make peace over Ukraine, then they'll want to get back in the dollars, wouldn't you? It doesn't make any sense. Say, oh, we want to get back in the dollars. Like, who cares? Um, but that would make me way less bullish. Um, Two, like real tightening in the US, obviously, would eventually make me less bullish. But that doesn't seem like it's happening. That again, head fake in the market, everyone gets kind of washed out of the asset class. Three, fixing the banks in China, which is not going to happen, clearly. Like, no way that's going to happen. That would make me less bullish. So those are kind of the three big things. I'm probably missing one that would kind of, make me less bullish on precious.
I mean, people have talked a lot about EM central banks buying gold in Asia. I mean, is that linked to Ukraine peace and they're kind of the same thing, or is that a separate kind of story?
There's two stories there. One is for what I call like unaligned or misaligned countries, treasuries just became radically less attractive as a reserve asset, just radically less attractive, right? Like now, clearly, like I don't think Poland's going to turn around and like leave NATO, so they have their own reasons for using gold. But like if you're Turkey, okay, and who knows what Turkey's going to be in 10 years, I don't know, right? But or if you're China, or if you're any state that might be like Iran or whatever, but like any state that might be kind of in the middle, you have to be a little more worried about sanctions, and you have to be a little more worried about the liquidity of that asset class. And the kind of the reason that treasuries were the gold standard for reserves was because it was the most liquid asset in the world. Well, we told Russia, it's not liquid for you anymore. You can't trade it. You can't get the coupons. You can't use it. So if you're Russia, why would you buy another treasury again? If you're China and your long-term goal is to get Taiwan, why would you buy any more treasuries? And you see this. You see official treasury holdings in China go, they're down to like 400 billion. Now they're stockpiling a bunch in Luxembourg and Belgium. But again, that's harder to sanction. They're kind of squirreling it away in places that it's like harder to sanction. And so that's one big trend. The second trend is like, if you're just a little emerging market who's not in this like great power game, it's a good source of diversification, and you see it going up and you're like, okay, it's going up. It's a good source of diversification. I mean, I don't know what Brazil's holdings are, but Brazil's in BRICS and they're not 100% aligned or whatever. So you would imagine that they would try to go get some gold too. I think, India is kind of a special case because they're also in BRICS, but there's just also a huge history of monetary instability and, familial accumulation of precious metals there. So it's both. It's like, sometimes central banks are an expression of the investment preferences of the people in that country. And so you could expect that countries where households like to accumulate precious metals, that their central banks would too.
And as you've mentioned silver a number of times, I mean, from a kind of framework perspective, how do you think about silver?
Yeah. So let's go back to like demand and supply, right? So I got involved in the silver trade partially because of this gold trade, right? I was big gold bull and I started doing some work on the history of, where's all the gold and silver? And you just start asking questions like, okay, there's only 8 times the silver as there is gold, but it's trading at 100 times. That seems kind of weird. You don't want to, bet your whole life on that dumb line though. But that's where I started seeing more of this like just solar demand going up, 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 up. And I'm a big AI bull too, right? So I'm reading these, thought pieces saying we're going to need 1,000 times more electricity. Oh my goodness, all these, and a lot of that stuff is playing out, right? We need a bunch of data centers. I don't know if you saw the Dario interview with Dworkesh like
Yeah,
last week.
I saw that. Yeah. That
10x,
was
10x, 10x, 10x. Where's all the energy going to come from? Where's all the energy going to come from? And so if you're an AI bull and you're not an energy bull, you have a lot of problems, a lot of dissonance, right? Or my thesis on dissonance, a lot of dissonance. And so clearly natural gas at some degree, right? Because that's where a lot of the flex fuel is. Clearly there was going to be a shift in perspective around nuclear. And you saw Germany kind of like shooting themselves in the face by closing all their nuclear plants right as they got their natural gas pipes cut off. And then for me, solar was a big thing because it's green, because there's a lot of that energy we can capture. Elon talks about this a lot, but once you convert the raw materials into this thing, you get energy for free. You don't have to consume anything. You don't have to dig it up out of the ground. So I was a little surprised when I just found out how much silver was going into these panels. And then I got into it and I said, wait a second, you're telling me that the more recent solar panels use more of this silver. That seems kind of interesting. And, I think 20 to 30% of mine supply is getting captured by this. And we've had a supply deficit for 2 or 3 years. And I'm bullish gold. And that's kind of where the like pounding the table silver kind of came from. Now, silver is both a precious metal and an industrial metal, which is why it's so crazily volatile, kind of, because you have these real demand supply pressures, okay? And you have this kind of super faddish investment demand, which is very fast. And so the solar panel manufacturers who, again, like they can use copper some days, you have to watch out, it can't go to like 1,000, but like, they need to buy it on a slightly regular basis. And the investor flows are super fast, in and out, in and out, in and out, as you can see in the markets. And so you have to think about it as both and just try to think about it every day as like a demand and supply issue. Like, okay, who's buying and selling today? Who's buying and selling today? And it's also, it's kind of hard to recycle. Like most of the supply comes from mining other stuff. So it's not like oil where when the price is high, you can just get a bunch more really quickly or relatively quickly. And so that's kind of how I got into silver. So, I think to go back to that central bank thing, I wrote a piece last fall, I think, called "The Only Money That Generates Electricity," the Campbell Ramble or whatever, which is my blog, saying before fiat, gold and silver used to be money, and you would deliver money into a bank and it would pay you interest, which is just so radical, right? You get paid interest on your gold. Whoa, imagine that, right? Everyone talks about the really old relationship because it's like, well, you're having to like borrow money to buy this thing. But imagine if you got paid on it. Well, if you're Russia, or you're China, or you're one of these like big central banks trying to get off the dollar, you could think about your silver as having a positive yield if you stick it in a solar panel, because you buy a bunch of silver, you put it in a solar panel, and now you get free energy, and that has some sort of monetary value. So to me, it seems obvious, and again, like maybe not right now because the price is so volatile, but it seems obvious that central banks will start accumulating silver again.
And you mentioned copper there as well. I mean, many investors I speak to love copper because it kind of plays into the electrification story. There's the supply demand sort of story. There's ongoing China demand perhaps. So how do you see copper? I mean, do you think that thesis is correct? This kind of medium-term bullish copper view.
I'm more copper. I think people are a little bit breathless about it because, again, like the commodity market doesn't care that 5 years forward we don't have enough. Like at least it doesn't right now. The way that translates is buying and selling today through a futures curve, which means that a bunch of folks like you and me have to go out and buy futures, and then people will go and store that and wait for that big supply demand gap. And you do see a big build in inventories as people kind of do that a little bit. Some of that's tariff related. So I am bullish copper. I'm writing a piece called Copper versus Iron as a way to kind of explain that to people, which is, iron creates steel. Most of the steel demand was going into Chinese construction, these like big mega houses that are kind of not even getting finished anymore. And so for me, the diff trade is definitely long copper, short iron. And that's a way to kind of hedge yourself against just the daily moves and the flows. So I'm bullish copper. I haven't done the like as deep a dive as I would like to get super high confidence, but I've been long the miners for about 6 months, and I kind of go in and out of the futures here and there, and I'm probably going to buy some more this week actually. But so yeah.
And you've touched on China a number of times. Of course, China has all sorts of influences on commodity markets, either through its growth model or through inventory building and security issues and so on. And at the same time, there's this huge debate in the macro circles around China growth. There's the doomers, China's going to collapse any moment now. Then there's other people saying, China is the future, engineering run by engineers and all of that type of stuff. So what do you think about all of that?
That's why China is so fun to analyze. It's always both. You go to Shanghai, you go to Hong Kong, and you go, whoa, this is the future. And then you go, 20, I don't know, 30 miles outside of Beijing, and it's like, 19 and 30 or whatever. And so it's just this country of two worlds, right? And you have this incredibly dynamic, incredibly innovative, incredibly productive manufacturing sector. And you also have these banks, which, just go look at some of the websites. Like, I don't mean the top 5. They have like thousands of banks, all these like local banks. And I remember this is now almost 10 years ago, maybe the website's a little different, but I would go to these, like, I would just start clicking on the links, this way I do it by hand. And I would like go to like the local bank in, Henan province, the local bank in Hubei or whatever. And you just click, and they all look the same. They all have like the same web designer, and they'd have like a slightly different logo, and it would be like this like really weird, like look almost like a fake website, right? And it doesn't mean that the bank's fake. It would just mean that like you kind of got a sense of like their operations and the sophistication of their technology stack and that kind of stuff. And then you go look at the balance sheets and you go, whoa, right? And then you look at how complex the balance sheets are and all this channeling business and that kind of stuff. And to me, it was, a little bit Emperor Has No Clothes moment where you're like, man, they are just, this is a gong show. You know what I mean? Like, this is House of Cards kind of. Now, again, they do an amazing job. The government does an amazing job. And people yell at me about this all the time on Twitter, right? But they basically have their cake and eat it too, because every asset in China is almost like government guaranteed somehow, right? You have the central banks, sorry, the central bank obviously is, but the state-owned banks, which are pretty stable, they then channel money into these like local banks or private banks, who then channel money into these like local or quasi-local projects, this LGFE, local government financing vehicles. Some of that gets put in a WMP, as we talked about. And so you go all the way down the stack, and some, poor farmer or whatever, bless their soul, is convinced by some local banker to buy some crazy derivative financial product that's got 8 layers of quasi-government guarantee on it. And you look at the amount of credit explosion, and you do any kind of back of the envelope math. Like, for example, just take Evergrande, which is, they still haven't resolved Evergrande. It's been now 5 years since they basically defaulted. 5 years. The foreign debt holders got like 0.1 cent on the dollar, 1 cent, I think it was 99.9% loss on the foreign debt for a bunch of these property companies. And the local banks, the mainland banks, have basically taken almost no write-downs. So just imagine that, right? Imagine for 5 years, you tell the foreigners you're getting 0, and the local people, don't worry about it, it'll be fine. It's just it strains credibility, right? And that's because this kind of power of narrative, because of this power of, well, we control everything, but we're not responsible for everything. And so I come across sounding a little bit tinfoil hat about this, but just because when you stare at it all the time and you see the kind of narrative warfare, it's both. It's just both things. And so I think the challenge of China is real. I think that we have a lot to learn about manufacturing from how China manufactures, right? I think they are investing in robots, and the robots are pretty good. I also think, and I get yelled at this too, that a lot of the videos you'll see about robots are fake as hell. right? And they have a robot doing like 1,500 flips on like its pinky or whatever. And you say like, hey, like, I don't know, that looks kind of fake, like CGI. And everyone's like, oh, you don't, you disrespecting China's like rise. I'm like, no, like, I think they're probably better robots than we are. And then this other video is like legit, like it happened last night. And they're pretty great at robots. Okay. And the robot can do 1.5 flips, and that's amazing. Okay. But it can't do 10 flips. Yeah, why? You go to Shenzhen, blah, blah, blah. Anyway, so I'm being a little bit, whatever here, but
Understood. I mean, just on that, in terms of just straining credulity, I mean, how do you deal with stats and data in relation to China and commodities? So, you hear stories, okay, inventory building or demand or industrial production, just all of these sorts of things, and you're obviously very data driven. I mean, how do you
yeah,
cope with that?
exactly. Exactly. So I'll give you an example. Okay. So this is now, again, like 10 years ago, but they have this thing called fixed asset investment. There's lots of ways to count investment. One is called fixed asset investment. There's gross fixed capital formation. There's a bunch of other stuff. There's CapEx. There's fixed asset investment. Okay. And then you have national numbers and provincial numbers. And so if you went to the National Bureau of Statistics, and you can still do this, although they've definitely massaged it down, in 2000, like, I think it was 16, 18, and you just added up the fixed asset investment for each province, you got something like 80% of GDP was fixed asset investment, 80% of GDP. Okay. Now, these numbers weren't supposed to align. This was just asking a province what's your fixed asset investment. If you looked at the national stats, it was like 60. So again, there's a huge discrepancy just in the provincial versus the national numbers, right? And then that what's probably happening is they're counting land purchases as fixed asset investment, which you're not supposed to do. Fixed asset is a non-land asset. It's like a, building and equipment, something that's like a fixed asset, not like a piece of land. Uh, and so you go, wait a second. So they're double counting land, or they're, how much of that is hitting their investment numbers? And then you go look at the gross fixed capital formation, which is the like GDP level stats. And they say, well, gross fixed capital formation is 50% GDP. And you're like, but if the FAI numbers are so messed up, what's the likelihood that the GFC number, the GFCG or whatever numbers are messed up? And then you go, well, wait a second. Everyone talks about this like crazy high savings number. Well, in GDP counting, investment is equal savings. And so where's all the money coming for all this investment? Oh, it's money printing. And you go, oh, interesting. So you're printing a bunch of money. It's going to invest in, a lot of that's buying land. That's been counted as GDP. How do you know that that's not messing with the GDP numbers? And you go look at the GDP numbers, and they're 5% every year on the dot, right? Then you go talk to people involved in this, and they say like, oh, the GDP number comes out like a day after the reporting period's over. And you go, that seems impossible. It takes us like a month and a half. And so you asked the right question, which is a question I'm asking as my first year, which is like, how do you trust any of these numbers? And it's just that amazing thing of being an investor, which is you never know. Like, you never 100% know. And you just have to kind of live in that uncertainty and look at stuff. And then you notice when they turn off the numbers, or you notice when they turn them on, and just don't put your life on it, basically.
Yeah, that makes sense. And I did want to ask about oil. You mentioned you have, or oil is one of your areas of focus. Beyond kind of a short-term moves, like from a medium-term perspective, what's your take on oil?
Yeah, I haven't been that on top of it the last year or two, so I'm not a little bit better on the other stuff right now. But from what I can tell, it's just really the story of pretty well supplied market. I mean, a lot of the shale is getting turned off right now, so that usually leads to some sort of bottom where you have kind of the prices go down. Uh, People turn off that short-term investment in shale, which is kind of the flex supplier. There's two flex suppliers. There's shale and then Saudi or OPEC, right? And so the price, bottoms. We turn off shale, inventories get low, the price rips, shale comes back. And it feels like that's kind of where we are in that market. I don't have a lot of details on like the exact timing of that because I haven't looked at the data honestly that much. And obviously the role of EVs is challenging the long-term perspective. There'll be some oil demand from data centers, diesel oil or generating energy from it, but we don't do a lot of that in the West. Mostly that's in Eastern, and a lot of that's coal too. But I think you have to worry about it a little bit from the EV perspective because those cars are just getting very effective and
Yeah.
it poses a big question.
Yeah, and now we talked a lot about AI, so let's kind of confront AI now. And you wrote a really interesting piece called "Long API, Short Slides," which was yeah, I read it and kind of I went, aha, that makes a lot of sense because I mean maybe I'll let you explain the idea, and then we can go from there.
It was a little bit of a reaction to software getting bombed out the last couple of weeks. And, I had this joke. I was like, software is dead 2 weeks ago. And then all of a sudden it becomes very memey. I don't think I was connected to it. I think I was just coincident to it. But the answer is it's not really all software because if you think that AI is going to automate a bunch of this labor and a bunch of these jobs, the reality is that the way it does it is it creates software by gobbling up other little bits of software. That's how software gets built, right? You take some open source thing, you put it with another thing, you jam them together, you make a front end, all of a sudden you have another piece of software. And if you watch or use Claude Code or any of these like coding agents, you notice a couple interesting things, which is one, like part of what they do that's beautiful is they'll be like, oh, I need a database. I'll just go download a database. Oh, I need a front end framework. I'll just go download a front end framework. And you realize one, that like the choices of which software the AI likes is going to be incredibly important going forward, like incredibly important. It's almost like Google search engine 2005 level important because you're going to have this, and you see this explosion in building. And if they're all using 3JS or whatever, there's a chart on internet, 3JS, consumption going up like crazy. That's agents gobbling up that framework or code or whatever it is. And so a lot of these things charge by the API, they charge by usage. And that means we're going to have a bunch more software. And what the agents consume should do pretty well. So that's the API part, right? This notion of, if robots are making software, what they consume is a good investment or is going to have demand support. And conversely, that explains a little bit of why generic software is getting crushed, not because it's going to go away, but because the margins have to go down because the supply has gone up so much, right? It's so much easier to make software that the margins will inevitably compress. And so that's the Monday or the Salesforce kind of getting rocked. But then on the other side, the thing that I thought that was really vulnerable is the folks doing all of this kind of research work or management consulting work or kind of low-level tech work, which is currently getting outsourced to consulting firms. And so, that was the short slides part of the argument, which is there's a lot of people who kind of outsource this kind of mid-tier of labor. And I don't say mid-tier to be insulting. I mean, it's actually quite skilled, okay? But it's not the, chief technology officer level stuff. It's like everything kind of below that. And so, to me, the trade was buy the stuff the agents are going to buy, right? And sell the people that are basically competing with those agents.
Yeah, that makes absolutely a lot of sense, and that sort of resonates with the way we're using AI as well. I mean, for us, it's all about API management, at some level. And there's a cost associated with that. So
yeah,
and let's kind of talk a bit more about what you're doing on the data side, and Rose AI. So what's what's this this platform that you're building?
Yeah, so Rose, there's two ways to think about Rose. Okay, at the highest level. And really the goal of Rose is to facilitate the AI transformation of investing. And long term, there's a question as to how much of that is a piece of software or how much of that is just an investment firm which runs on AI. It's a big existential question in my life because I kind of been bouncing back and forth between these two things my whole life. So there's a chance that one day Rose just becomes a firm that uses data and AI to make money in markets. The granular level, right, is build the APIs and the pipes that allow both quants and AI agents to quickly access and buy and warehouse data, which was to me the kind of biggest constraint in the Bridgewater systemization process that I saw at Bridgewater and in my own life as a systematic investor, which is that really, as you mentioned, like that backbreaking work of setting up APIs and modeling the data. And, it's even like you go to FactSet or CapIQ or Bloomberg and you're like, what's CapEx? And the data is not aligned and it's in different units. And, one of them's in months, one of them's in quarters, and like, one of them's an annual, and you're just like, oh, and you just spend so much time doing this. And to me, it was like AI is going to do the backbreaking work of this. How do I create infrastructure that allows people to tell an agent, go buy this data, just go get it, right? And if you're familiar with, I mean, you see FactSet and CapIQ and all these stocks getting rocked. So I have to write about this soon before it's not no longer timely. But the old way of selling that software was, you go to a conference, or you call some guy, and he's like, oh, take a sales call, and you take 15 sales calls, and then they try to charge you like $1 million for like a bunch of data you don't need. And you're like, man, I need like a single time series in my spreadsheet in the next like 5 minutes. And so like that's like the granular level, which is like solve that problem. And so we work with big financial institutions. Goldman's a client, JP Morgan has been a client in the past, in piping and cleaning data into their big ecosystems. But the ultimate goal is just to enable that transformation, right? And basically enable the like AIification of your data stack, and also just the AIification of investing in general.
Yeah, that makes a lot of sense. Yeah, and I'm going to definitely play around with the product. I mean, it makes a lot of sense the way you framed it as well. Now, I did want to round off with a couple of personal questions. One is we do have some youngsters listening to this podcast that people are in college, they're going to graduate this year, or had just recently have graduated. Many of them are struggling in the labor market. I mean, so what would your advice be to youngsters in this kind of AI world?
Yeah, it's hard because the old advice is a little bit different than new advice. Because my old advice used to be like, just go make stuff and try to get it into people's hands, right? So go do some quant work, like make a strategy, put a pitch together for a stock. I still think that's true. It's so like the technical ability to do that has now been automated. So like as a hiring, I'm sure you experience this, like you'll get something from someone and you're like, oh, this is definitely AI generated. That could be okay. It's not necessarily bad. It just means that the bar is way higher. So I think like, you definitely want to lever these tools. The problem is that there is a process of learning that occurred from doing that really backbreaking work of figuring out how to set up the API, or what a correlation is, and like how to actually make even if it's Excel, like make a correlation in Excel. Like it's not a trivial math thing to do if you've never done it before. And that muscle memory is really important. And so I think you're going to see a lot of like the emergence of like, and crypto is bad at this too, because you have all these assets which have like lots of data, but like no fundamentals. It's just like meme stocks or whatever, where they're kind of very sophisticated, almost like surfing on all of this like content, but have like very shallow understanding. And so I would use AI to build a deep understanding in one or two areas. And really, when someone's hiring you, they're not hiring you because you made a pitch deck that they think the trade is good. I think that's a mistake that people have. It's like, it's almost certain that the person hiring you does not care about your pitch deck for the trade. Okay. They want to see how you think, they want to see you operate, because they want to invest via your hands, right? So how can I trust you to do that? And so I think that depth is really important. And so, or like hype or breadth, like, oh, I built an entire trading system and a risk management framework, and then I can answer questions about it intelligently, and it's been running for 10 years, blah, 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 blah. Like, but I think I see a lot of people faking that as opposed to really doing it. So I think it's depth. It's like, how do you think? And then use the AI as a superpower to kind of, to lever that experience is kind of what I would recommend. And then also just like reading as much as you can, like reading about investing, reading about the world, like trying to figure out where the world is going. I think a lot of young people have a gift, which is they don't have too many preconceived notions. They're not locked into kind of, boomer quote unquote perspectives, that kind of thing.
Okay, that's great. And you mentioned reading. So I do like to ask my guests this as well. I mean, what are some of the books that influence you, or some books you would recommend in general?
Well, first they should read the Campbell Ramble, which is my blog. No,
I'll add that to the show notes as well.
Yeah. Just kidding. But so I mean, Liar's Poker, you got to read Liar's Poker, just because it's a great description of trading floor life, which might be dying. Smartest Guys in the Room is really important. That story of Enron. I always really liked what's that book on LTCM?
Oh, Yeah, I know the one you're talking about. Yeah. So when genius failed, was that?
Yes,
the one?
exactly.
Yeah.
So it's very related to it. That's a great book. That's an amazing one. I remember Traders, Guns, and Money was pretty fun. This is a derivatives guy one back in the day. Taleb books are pretty good, although sometimes hard to get through, and he's his own kettle of fish.
Yeah.
I read a bunch of the stuff that Bridgewater puts out, like a lot of their, research reports and that kind of thing to show like macro. Innovator's Dilemma. I don't even know if I've read the book, but just be familiar with the concept, the notion of
Christensen's.
really
Yeah.
important. I have a reading list that's like 200 long or whatever.
I mean, I think this is more than enough. You've already rattled off more than 5, which is much more than what most people do. So no, they're great recommendations. And then just to round off, you mentioned the blog. I mean, what's the best way for people to consume your ideas, reach out to you, and so on?
So I'm very active on X, AB Campbell, because I couldn't get Campbell. Everyone's like, why do you have the B in there? I'm like, well, that handle marketplace isn't as good as you think it is. That someone's been sitting on that handle forever. So AB Campbell on Twitter, and then CampbellRamble.ai is the blog. And then, I try to be pretty active. You'll see I get yelled at a bunch, but it's all part of the fun and game. So
No, that's great. That's been excellent, Alex. I learned a lot on this interview, on this podcast conversation. Yeah, and good luck with everything. I think the work you're doing is fantastic. Both in terms of the thought leadership that you're doing, and this work on AI, the platform, Rose AI, and so on. So just keep up the good work. Let me know anything I can do to help.
Thank you, sir. Thank you for having me on. It's been fun.
Great. Okay, then appreciate that. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. Finally, sign up for our free newsletter at macquarie.com/free. We'll be back soon, so tune in then.